Okay, guys. Yeah, thank you again so much for joining us. I hope I know that we've reached out to you all different from different points, different contact points, but generally, we've started a thing called an innovation space called re-inlab. I think it was in November last year, and we're looking at several subjects and topics where we think there can be efficiencies made, particularly in the DLT space. But we want to understand a little bit more about the ILS market itself. It's one that our members from the re-inlab space have identified as showing potential, but we needed to get experts on the line to really understand what some of the challenges are. We're not trying to go straight to solutions. We're just trying to understand the marketplace itself. And that's what we aim to explore with you today. So I do have a series of questions lined up, but it is a bit of an open discussion. So please just jump in where you feel and comfortable. Um, Obviously on the call, we've got Frank. So just going to identify who the speakers are mainly. So we've got Frank. You're from MSG Finance. Yes, correct. Benjamin, you're from Credit Suisse. Tobias, are you from MSG?
MSG, yes.
MSG, perfect. Apologies. And James Vickers from Willis Towers Watson. And then John Carolyn from B3I. So those are sort of the main people. The rest of us are here just to listen to you, to absorb, and to maybe ask some questions of you of some of the material that we have there. One of the person who could not join us today was Alexander Braun from Uni Saint-Gallen. I spoke with him yesterday just around this topic, just to get his inputs. I do have a short 2-minute video just to play. You can just hear his inputs, and that maybe start us off in the conversation here. So I'll just share my screen and play that for you, so just bear with me. And if there are any questions from the start, please just shout, and I can answer those as soon as possible. So this is Alexander. As I said, I had a quick catch up with him yesterday, and it's just a really nice conversation around some of the benefits he saw and some of the conversations. So I'll play that for you now. And just let me know if you can hear sound. You should be able to hear sound.
My name is Alexander Braun. I am an associate professor of insurance and capital markets at the University of St. Gallen, and in my research, I focus a lot on the ILS markets worldwide. And I was asked to provide a little bit of input for this event regarding the connections between DLT, distributed ledger technology on the one hand, and then of course the insurance-linked securities market. So one thing that comes to my mind just spontaneously are issuance costs. So ILS in most cases still have a lengthy issuance process. A lot of third-party fees involved in setting up a special purpose vehicle and doing all the legal paperwork. So potentially using distributed ledger technology and a tokenization of the risk instead of securitization of the risk could be a way to lower those issuance costs and make the instrument even more attractive than it already is, both for the sponsor side, the cedent, but also for the investor side. Then a second point that I would think of when we discuss B3I and distributed ledger technology plus ILS is the automation of the settlement process. So what I've read about is that B3I is already working on automation of transactions such as excess of loss contracts in the classical reinsurance space, and obviously that type of technology could be really helpful in streamlining the settlement process in ILS as well, in automating the process of claim submissions through the whole industry value chain, starting from the original risk holders to the primary insurers, and then to the reinsurance companies, and finally to the capital markets. By means of smart contracts, you could actually automatically and very quickly assess which parts of the claims that have been submitted by the policyholders are actually to be paid by which risk bearer in that chain. And then a final aspect that I think could be relevant is the whole question of secondary market trading, because right now the cat bond market, which is one of the major ILS segments, is basically increasing in liquidity from year to year, but still the market is a classical over-the-counter market where you, as a investor who wants to trade out of a position or who wants to buy a position in the secondary market, need to go through brokers and need to find a counterparty through a classical process involving a lot of coordination via email and phone. And using distributed ledger technology, putting this whole trading on a, let's say, a decentralized trading system using DLT could have a significant impact on the attractiveness of trading in ILS markets, I guess. So those would be three areas that just spontaneously, I think, are relevant in terms of DLT and ILS. And yeah, I'd be keen to hear what the discussion brought to light at the event. So thanks a lot, and I wish you guys a great event.
So that was Alexander. So he's a professor at the University of St. Gallen. So we went to him for a bit of an outside view on the marketplace, and he gave me some nice questions to run through. My first question for you guys is if I go around the table and ask, what's the first challenge that comes to mind for you guys in the ILS market? Is there one sort of more than anything else, or are there semblance of a few? Frank, would you mind if I start with you? If there's a first challenge in the ILS market that comes to mind?
Yeah, I think the three topics that Alexander has addressed very different in their weight. I think when it comes to liquidity, I would be very interested to know from market participants, are they interested in getting more liquidity in the market? Because I can remember in earlier times when it comes to securitization of assets, I had the impression that some of the market players weren't really interested in getting more liquidity, either on the side of the sponsors or if you go to the side of the investors, everyone was happy. It was buy and hold investment. So I'm very interested in getting more impressions from market participants, whether they benefit from this liquidity and whether they want it.
Thank you, Frank. Benjamin, do you mind if I move to you for that same question? Just one big challenge that maybe that you're facing.
Yes, thank you. So first, maybe I can somehow reply to the question posed by Frank and regarding the liquidity. I think from the sponsor's perspective, I guess it's not so much of a concern because the sponsor's objective is to, in effect, have reinsurance protection, be it securitized or not, and then they tap into capital markets, and then what happens in the secondary trading is not much of an issue to them or concern. So I would say, yeah, the market is interested in liquidity. However, from an investor's perspective, it's difficult at the moment to understand how certain technology that have been touched on, in particular by Alexander in the video, would bring additional liquidity to the market. Of course, it's an OTC market, and it's a very small market with a few broker dealers, and everyone knows knows each other, and yeah, it's traded over the phone and over email. And so there, I think what can be improved, but it's not different from other asset classes, is the settlement process potentially, because when you settle securities over DVP, we've seen it a bit in there in certain studies that you can improve that, but it's valid for ILS, but it's also valid for other types of securities. There might be improvements there, but it's not specific to ILS. But what would be more specific to ILS is standardization of the underlying data. And I think B3I have worked on the reinsurance side of things with their standardization of contractual data and the use of DLT to have a unique version of the truth, and maybe implement smart contracts to facilitate some processes. And I think it might be useful for the standardization of cat bonds, because for cat bonds in Bloomberg you would see basic securities information, the coupon, maybe the payment dates, the ISIN, the redemption date, but you wouldn't see the underlying structure. And these are things that everyone in the market enters into the system, not only at the issuance of a new bond, but also upon resets, which happen not for all cat bonds, but for many bonds, you have a yearly reset where you change potentially the structure, the coupon, certain parameters, which you wouldn't find in a unified way or in a central source. So there, I think there can be improvements possible, but it starts with a common data format, and maybe potentially DLT could add, and it would be nice to have, and could add to the the operational efficiencies. But it starts with a common data format, which I think is not there at the moment.
No, thank you, Benjamin. And I'm keen not to put words into your mouths and talk and push DLT, but you obviously addressed the data standards piece there, which I think we'll get to. My question set is based on my conversation with Alexander, just to make it fluid. So I'll keep us moving through. But if there are things you would like to talk about and focus in on, please do. I could see John nodding to some of those points as well. So please just raise your hand and let me know if you would like to dive into any part of that. But just to keep it moving around the room, same question for you, James. Is there a significant challenge that you see that's top of the table, or is there something else that's more pressing within the ILS market as a challenge?
Yeah, I mean, I come at it from a point of view of, as a reinsurance broker, what clients are looking to buy. And, ILS has been around now for about 20 years. But unfortunately, in the last 5 or 6 years, a number of the structures that were put in place have not actually worked as advertised. And they've been a disappointment for both the issuer and the investor in the way that they've worked. And this is inevitable in a time when people are pushing out and testing boundaries. So I have a more fundamental question: is what are the likely structures that are going to work appropriately in the future? It's no surprise that we're seeing a swing back to traditionally tradable and rated cat bonds, when everybody thought collateralized reinsurance was going to be the way forward. But there's another very fundamental issue that's sitting around, which is actually the way that original claims are developing. The days of, a simple and inverted commas straightforward claim that will be settled quickly, I think are pretty much over, unless you go down a parametric route, which we can talk about in a minute. So we are seeing this move that issuers want indemnity paper increasingly, and we're seeing a lot of the ILS investors creating rated paper vehicles, or they are going directly and setting up relationships with end user reinsurers. So I think we have to be, all the operational points that are made so far, absolutely 100% agree with. We need to make that much smoother. But for me, the question is, what is going to be the dominant form of ILS transaction in the years ahead? How is the plumbing between risk and capital going to evolve to a stage that it actually works for the insurance companies who are selling policies of indemnity? Let's not beat about the bush. Parametric products, they're talked about endlessly, but it's a tiny market at the moment. It's a tiny market, and frankly will be unfit for purpose for the vast majority of the insurance risk. It'll be there, but it'll be at the edge. So you've got organizations issuing policies of indemnity, which may take years to settle. How do they explain that and make sure that the ILS capital that would like to be exposed to this insurance risk actually is there and can perform? My gut feel is, I think that sidecars, or being an old-fashioned chap, I could call them a quota share reinsurance treaty. Those may ultimately prove to be a better long-term vehicle. And that then has a knock-on effect on, because of course the administration of that single B2B thing, it becomes a lot potentially easier. But now that's where I'm coming from. It's unclear to me where the dominant sort of structural form of transferring risk is going to take place.
James, you mentioned at the start that some of these structures that are currently being put in place over the last 5 years have failed. Has there been one root cause, or is it a multitude of things?
I think it's a multitude of things. I think there was an element of naive investor money, believing models slavishly, when more experienced underwriters were thinking this is crazy. And of course, the clever ones among them, they arbitraged their own risks against naive capital. Plus ça change. So you've got that problem. I think that some of the collateralized structures were put in place, and the collateralized release mechanisms around them have proven an absolute nightmare. Particularly, let's say you've got a potential COVID claim. Well, we all know the original COVID claims are settling very slowly, let alone how they're going to be recovered under reinsurance contracts. And again, let's not beat about the bush. A lot of those reinsurance contracts will be, COVID claims will be settled on a sort of ex gratia, no fault basis, sort of relationship type deal that reinsurers with their major clients know and understand. Well, that's not going to really work in the ILS space. So there's a lot of friction around that. So there's this big move away from collateralized reinsurance and people understanding the value, at least that their trading partner is rated paper.
Excellent. Okay. Tobias, would you mind answering the same question in terms of the big challenges?
I don't want to add new things. I guess most of what we currently see has been mentioned. Nevertheless, I'm coming very much from an operational and IT perspective, and there is an element that I guess it was Benjamin mentioned, and that is the standardization of data. And don't want to put words in his mouth or repeat just what he said in order to keep it short. However, if you remember what Alex said in the beginning, and it's something that Alex and I have spoken about already several times in the back, and he already has published a book about that, is what that actually creates. And that is very much what he pointed out as what he calls the issuance costs, all the fees, the legal things that are created in the back. This is just, it sounds very simple. There's a standardization of data. Let's standardize this bit. It doesn't matter because we are dealing with so much money. What kind of coverage, what kind of fee are we talking about? However, if you sum this up, it actually generates quite a large amount. That is something that, coming back to what we are here for, to generate or figure out kind of a use case or a potential solution or whatsoever, is something I could really see us touching a ground that is beneficial for all of us.
Yeah, and you're right. We'll get into more of that stuff later on, because obviously I spoke with Alexander. John, I'll give you the benefit of having everybody's answers in your hands. Is there anything else you'd like to add or sum up?
So yeah, there's definitely something I'd like to add, and I'm no ILS expert. B3I, I guess we're providing a platform to have this conversation, and maybe a little bit of background. This is something that comes up with B3I very often. What we don't want is to be technology looking for problems to solve, but certainly many of our stakeholders have put ILS on our roadmap, and my own personal experience is limited, but 14 years ago, I was an auditor on providing comfort procedures around the prospectus for a structure called Crystal Credit, which was the securitization of trade credit by Swiss Re. And I remember auditing the loss tables. And I think, and it comes back to this data point, I think today about what B3I is doing and how there's an element of the technology that provides immutability and certainty of the boundaries of the risk that are covered through the contract certainty that is enforced by a single version of the truth. Then on top of that, where those are smart contracts that are automated, it starts to, I see it, but there being the potential to create transparency for investors that doesn't exist today. And then also, if we think about managing quota share treaties that would be subject of an ILS, there's a lot of operational work in administering those. And if we can, like, you could see where the technology could offer some significant operational benefits and transparency that that the investors in ILSs could benefit from. Again, I'm not a participant in the market, so I don't know. I don't know where it potentially goes. But there's also this other angle around if you've got this granular transparency around the underlying risks and how they find their way into the structure, and you're able to digitize. We've got digital assets, and in many jurisdictions we now have to be able to, we create them, they become far more tradable. It feels like there is a nexus of the technology with that underlying risk, that there are shorter pathways of for risk to travel to capital. But again, we're looking at it through a technology lens, and it's got to be following where the market demand is, and that's really the we've had ideas presented to us of what these look like. So James, you touched on the parametric one. That one is obviously quite straightforward and understandable. But you know, we want to know that we would be doing something relevant for market participants. So I'm very interested to learn and help facilitate the conversation.
I mean, just on that point of parametrics, I mean, yes, in theory, they're very simple, but actually some of the trigger mechanisms to get around the basis risk on parametrics, some of the trigger mechanisms are becoming extremely sophisticated. And yes, I can easily see a role for B3I in being a sort of validation or providing a transparent validation, but it would require, you know, being able to pull in data from all sorts of quite different sources, if I can put it like that. Some of the new ones we're working on, that they are, you know, sourcing data from all over the place and bringing it together in a way that then generates a trigger.
Yep.
I'll move on to our second question. And for me, this is, Tobias, this will play into your hands around what you're talking about. This is issuance costs. So again, it's something we've heard, and they can benefit from streamlining, is how Alexander put it. And this is what I just would like to get into your experiences of the work involved, or the steps that could be taken around this challenge itself, around issuance costs, just so as help us understand that part of the task. So Tobias, would you mind if I start with you? You're on mute. Sorry.
I think you can simplify this because there is no straight answer to this. In simple terms, you can have as many people involved or as many topics involved as you can probably imagine who are players in this industry. And just take one, and then want to make more precise. I take just the example of legal fees, for instance, that sometimes have to be paid. That depends on how many parties do you have, how many legal advisors have to be involved, how many different interpretations. We have heard about earlier about contract certainty, just to add one element. And James mentioned also different sources of the truth that have to be added. They can be interpreted. I think I can easily stop here and you think about the whole process, and it will come to as many, let's call it issues, as you can imagine. And to find a ground on that, or a common ground on that, is something that me personally, from my experience, I guess data is probably a key to this, or at least I don't want to go into, and I use the term on purpose here, I don't want to go into a next RichlyCon or whatever that is, but at least to understand of how things can be matched, monitored. I don't want to use the term compared, but that we are sure that, you know, if you have two lawyers and you don't have three opinions, and that you get a kind of a certainty in that particular element, in that particular area. That is something that reduces the cost. And I'm just talking about legal costs for now. You know, there are some others as well that you can add to that.
So if I ask that question to Benjamin, I'll alter it slightly based on what Tobias has said. So putting legal costs aside, what's the next big part of issuance costs that you find is the next challenge?
So yeah, I think the the best type of party to answer that will be a sponsor, like an ILS sponsor, or their investment banks, like all the structures which are well known, like again Securities or Swiss capital markets, and other names in the cat bond space. But it's clear that they're because it's a regulated market, then there are a number of structuring costs and legal costs associated with an ILS, because you need lawyers to draft all the documentation. You need structures to work with the sponsor to establish the best underlying protection. You need different parties, potentially index providers. You need a modeling agent, reserve specialist. There are a lot of parties involved in a catastrophe bond, or more generally an ILS, that it adds up to those costs. But I think this is in the regulated environment. It's difficult to go around, and if you want to save on those costs, then you issue something which is less regulated, or the so-called, club deals. Some people call them, private cat bonds, or it's a rather loose term, but it includes all these transactions where you don't have an investment bank, which is the initial purchaser of the security, but rather facilitating, like a reinsurance broker, the transaction, and the investor is basically purchasing the catastrophe bond, or the sidecar, as James mentioned earlier, directly from the issuing vehicle. And so that involves less costs. You don't need a modeling agent. The legal costs are smaller, and that exists already. And such transactions are also traded in the secondary market. It's a much smaller market than the what we call the 144A market, of cat bonds, but you do see some trading, and that's definitely an angle to save costs. But this is not a technology-driven angle. I think if you think about I think you mentioned earlier, Tobias, or at least I think you alluded to that adding to issuance costs might be tricky, because we already have a lot of costs. But I think there are a few quick wins, that may not be very costly, in terms of, well, I'm getting back to the standardization of data, which are which might be beneficial to market participants, just to make sure that data is updated for everyone in a timely manner, that we avoid manual processes or semi or automated processes. But even with automated processes, it's still a shame that we're not pooling resources, basically, because to give you a very practical example, you have an ILS in the market. It has a reset, so you basically receive a reset report, which is posted on a data room, and then you download that, and you have a lot of data fields which have changed, like attachment point of a reinsurance structure, the exhaust point, and maybe other parameters. And you either enter them manually in your own system, or maybe you have a parser, which is a program that will look through that data. But in any way, you need resources to develop that, to buy such product, or just to enter the data manually. And if there were a standard format of data, either with a central source or with a distributed ledger to have the data, then you would save a lot of time and effort.
No, yeah, Ben. Based on where the conversation is going, I'm just going to reshuffle my questions a little bit and bring data standardization up. But just off the back of issuance costs, Frank and James, I just wanted to give you a chance. If there's anything else you wanted to add to that conversation, otherwise we'll move into standardization. But mainly it's just around where if we talked about streamlining, it sounds like there's lots of parties, predominantly legal, and that's where part of the challenge is for issuance, by the sounds of things.
I mean, I just make a general comment. I mean, if people don't think issuance costs is an issue, I mean, it's interesting watching how some of the new regimes like Singapore and Hong Kong are trying to attract. They offer discounted fees, and that's attractive to people. It doesn't sound like a lot of money, $50,000, $100,000 grant, but it's enough to make people. But there's also, I think, a perceptional issue for a lot of sponsors who are normal buyers of reinsurance anyway, because the reality is they never have to pay these fees. They never see them because it's lost in the brokerage. The brokers just absorb that, and maybe the brokers are giving them a rebate anyway. And of course, for most seeding companies, it's not appearing as a fee, it's not vatable or anything like that. It's just seeded off. But then all of a sudden, they issue a cat bond, and these are actual bills that are coming in, and the seeded department may not actually have a budget, and the people are giving them a hard time about the tax, etc., VAT, and all those things. So it really does matter. It has a disproportional impact on people's thinking. It's sort of a bit odd. You can be placing, hundreds of millions of dollars of cat limit and quite a large coupons, and everybody's getting bent out of shape about $50,000 of fee to somebody.
Thank you, James. Frank, any last comments on issuance costs?
Oh, I think I cannot contribute very much to that for concerning the issuing cost. I can only remember the term sheets of CDOs or CDO squared in the past. Some of you might know. The others might know them from the news in 2007 to 2008. I don't think it's very efficient to pay a lot of lawyers to produce such an amount of paper. I think if we move over to standardization, this will be a very promising way of saving issuing costs and of fostering the market. So I can't contribute more to that. Benjamin made a good point in my personal point of view.
Great. No, thank you, Frank. Okay, well, let's move on to standardization then. I actually had a question here that was a little bit more around the value chain, what happens in terms of a claim submission. And maybe you might feel comfortable walking me through. I had the question here, what is the reality of the value chain in the ILS market? For example, how many parties are involved in a claim submission? But actually, with data standardization, let's talk about the process of it. What sort of steps were you taking? Benjamin, you gave a really great outline just earlier. Would you mind revisiting it in context of a claim submission? Maybe, and just with this spin of data standardization, where are the opportunities? Where are those touch points that we're going to find for sort of making standardization of data and making the flow easier?
Yeah, so I think the claims are, from a claims perspective, basically, I think you would have efficiencies to gain with their basically the reports that you, as an investor, you get reports about the claims or the potential claims under a cat bond, and you get that rather early on, and as soon as an event is known, and there will be a development of the claims, and you would receive in general monthly reports, and that data is has a format which is defined in the documentation of the ILS, and it's very similar to reinsurance claim, basically.
Is it very structured? Sorry to interrupt. Is it very similarly structured each time, or does contract to contract, does it vary?
It is generally similarly structured, but it varies. For each cat bond, it may vary. And so, I mean, if you really think about the format, but the actual data is in general pretty similar, because you always have the same numbers that you would be expecting, such as the indemnity, the loss adjustment expenses, which are often with a factor. You've got often an amount which is expected to be paid in the next X days, and then this all adds up to the actual subject loss under the reinsurance contract, which is underlying the the cat bond. Here we're talking about an indemnity, but you would have a similar process under a parametric structure. But the format is often quite similar, but it's very standardizable. That's for sure. But it's in practice, it's information that you get from reports in PDF that you get notifications about and that you just download, that you can feed through your systems. But actually, when you for security, you will see the impact to you as a valuation impact, and what the markets makes of that information. So potentially marking down the price of a cat bond, and at some point when the claim is paid out, then you would have a principal reduction of the cat bond, and this is taken care of. Um, um, in there.
So Ben, I actually have a question for the group, I think, which is, so if there's value in standardization, why hasn't it happened yet? Maybe Tobias, you might have an opinion on this. Why hasn't, why? I mean, it's just that idea. Why hasn't standardization, if it's valuable, why hasn't it happened to date? And maybe where does the resistance come from? Is there a particular area? What's the reasoning?
Yeah, I think we play kind of a prisoner's dilemma here, If there's intransparency, you might think you are better than the other side, and you might earn a small margin over what the market price would be if there would be more transparency and more standardization. In the end, I doubt whether this is worth it, actually, but at least you can start playing this prisoner's dilemma game in the beginning, when the market is very small.
But surely, I mean, I'd be interested in Benjamin's view. I mean, most of this claims reports are outsourced to a claims agent, a third party. If I look in a traditional reinsurance contract, there isn't that third party. The primary insurer sends the claim straight to the reinsurer, but then the reinsurer's got his own claims department. He's got his own internal experts who will plow through and ask all the right questions and make sure that it's a valid claim. I mean, there would be an interesting cost saving if you could set up a standardized, transparent process which took out the need for a claims agent. But my question to Benjamin is, would you as an investor be happy to do that? Or would you say, well, that's no good because I'm going to have to go and employ a couple of claims experts?
Well, that's a very interesting point, and it relates a bit to what I was thinking about, which is that the claims process for the sponsor is actually very similar for a cat bond to what it is for reinsurance. You just have additional parties involved to basically check reserves and check claims. And these are meant to be independent because that's a requirement of the market, because the reinsurer in a cat bond is just is a vehicle which has a manager, but it's not a the investors are relying on the different parties managing the vehicle and also validating the claims to trust the whole process in the chain. So if I think in reinsurance, and I guess you have worked on that at B3I, then there are ways to potentially improve the trust throughout the process, and nonetheless gain efficiency and require potentially less checks, and that requires a lot of technological improvements, and all the way down to the original risks. But if that is feasible at the reinsurance level, then it may be by transition something that could be applied to securitize reinsurance contract, but it's just a different wrapper. We're still talking about reinsurance in general, whether the wrapper is a security or whether it's just a traditional reinsurance contract.
So
John.
Benjamin, I would expect then that you also sort of have some challenges if there's a secondary market. Claims information is price sensitive information. So how that disseminates to investors is something that one, and I'm sure as a regulated assets, there's a lot of thought that's gone into that. But I would think one needs to be very careful about how that information finds its way to the market and how you update estimates and that everyone is acting on the same information at the same time.
It's a very interesting point actually, because you have sponsors, insurers or reinsurers who are sponsors of cat bonds, who basically operate in two different markets: the reinsurance market and the ILS market. And the way they manage the information, especially around claims, is quite critical to the transparency, because those two markets overlap to pretty large extent, and you have a lot of ILS participants who have access to the reinsurance markets and then potentially to more information. So this is something to be managed by the market participants themselves, but also by their sponsors. So you have, especially if the sponsor is a listed company, is usually quite beneficial, because they wouldn't be able to disclose information even to their reinsurers before they would to the public, and then they often have a very strict process around publishing that information. But in other instances, it's trickier, and you can see that the some advantage can be taken by the by market participants who would benefit from additional information. But we also, as as asset managers, for instance, we're also very regulated and need to be very careful, and we have barriers of information in place to avoid gaining unfair advantage.
Yeah.
So that does it actually mean, if I understand it correctly, that we're talking based on standardization of data, that we actually talk about a streamlined or standardized process? Is that what we allude to?
I put it into just the context of the claims submission just to help the conversation, but it seems like there's a couple of things: data going out the door and process as well. And that's where James, I think, mentioned the claims third party. So they obviously have their process. How do you bring that and standardize that? That's what I would see. But for me, the question was just where can we standardize data in order to benefit the process? Claims might have been a bad example, but it seems like overall. I do have next section is on settlement, the settlement period, and we might be able to talk about data standardization there in order to facilitate that. Does that answer your question, Tobias?
Maybe if I can also add from a B3I perspective, we're trying not to envisage a solution. We're trying to coalesce around solvable problems. There's solution space that comes, but like they're just ideas at this stage. But we really want to just coalesce around solvable problems that the right people are involved, where we're not trying to boil the ocean, and we can demonstrate incremental improvements. So it's very, very open questions at this stage.
Yeah, that's good summary. Thank you, John. Yeah, that helps me out. So just to bring this around to the settlement period, one of the things that I talked about with Alexander as well, he was saying that it's a very lengthy process. And again, not wanting to push you towards solution, it's just what are the challenges you face around the settlement period? I've obviously said it's lengthy. Tell me otherwise. Is it? What takes part in there? And then the guys listening in on the innovation side, that help their brains think around, well, what's the next step for that? Does anyone have a preference on that? Frank, maybe?
Difficult to tell. Very difficult to tell. maybe I don't have a good idea to that.
Okay, not a problem. Does anyone, I mean, James, are you familiar, more familiar with the settlement period? What some of the challenges are in that?
I'm not particularly. I mean, because I'm not an expert in the sort of the administration of cat bonds, but I mean, the settlements of the premiums, basically the coupons, and I would have thought that that's relatively streamlined. My involvement tends to be much more when they're claims. Life gets more complicated.
Tobias or Benjamin, others will move on to another question. Is settlement period something that has a lengthy process? Does it vary? If it's not, then it's an area it's good to understand. It's actually not as big as it should be.
No, I would actually ask Alex why he brought it up.
Okay.
I think it's not specific to ILS. The settlement of securities are for ILS is the same or very similar to other securities where you have generally a clearinghouse which would ensure the the DVP, the delivery versus payment, and so you have an intermediary being the clearinghouse to manage that, and you can find studies. I think there are even some prototypes about how to improve that through blockchain technology to have basically decentralized process. But that's not specific to platforms. And the ILS market is is living with the state of the technology and securities in general.
Understood. My next question is, and I've heard it mentioned a couple of times, is that ILS is referred to as an over-the-counter market. Now, when you introduce technology, etc., is that a barrier? And what are some of the challenges with an over-the-counter market? All done on the phone, all done on email to a few parties. This is probably just where we're trying to scope the size of the market and some of the challenges associated with it. Does anybody want to kick off on that one?
I mean, the difficulty is that, when you're dealing with the underlying risk as a contract of indemnity, it does mean that there's always a lot more explanation that sits around it. I mean, if you look at traditional capital market products, a lot of them are rated around interest rates or credit ratings, which are really quite binary. Whereas a contract of indemnity is not at all a binary product. And if you oversimplify it to make it easier to trade, it loses its relevance to the original issuer. And in fact, if anything, reinsurance contracts are becoming more customized and more complex because the issuers are facing sort of all sorts of different problems, and the way they look to hedge their risk is becoming more sophisticated. So it is tricky, I think, to get away from it being a largely over-the-counter. I mean, we've had people have asked us in the past of, well, there's certain market reference contracts and things that sit out there, and people have said, could we use those and trade off them? We haven't found a single primary issuer of one of those market contracts who wants their contract to be used as a tradable index. What's in it for them? Absolutely nothing. What's the downside is everybody knows what they're up to. So I find it difficult to see how we're going to get away on the primary side from an over-the-counter market. Maybe Benjamin will tell me I'm wrong.
No, absolutely not. I think the ILS is a pretty small market, and I think there are ways to automate their the bidding process, or basically they're making capacity and their offer and demand meet basically. There's a limited amount of ILS in the market, and given at certain points in time, you have more investor demand, and then you will have a lot of trading happening. and you have certain events which could cause volatility in the pricing, and there, I mean, there's definitely an active secondary market, but there are ways to make these investors meet. Either it can be on the phone, it can be by email. It's actually in practice both, but it can be via Bloomberg chat. It's just traditional, securities trading. You can set up a platform where people will publish their bids or their offer or their asks, and I think you can improve that in different ways, but the reality is that it will not there's a little use case for an exchange, for instance, to have more automated trades, because you don't have a lot of volume happening. So there's in my view, there's a little need for such a exchange-based trading. So yeah.
Mm.
I think unless there's any more comments on that one, we'll move on. I do have one. We've also been talking a lot about the challenges of the ILS market. Maybe just go around the room again and just say, what's the next natural evolution for the ILS market? You know, James, you mentioned at the start of the call, there's been some attempts in the past, but what do you guys see as the next evolution in the ILS market? What's going to be the next big thing that changes it, or potential?
Well, I think the key is fungibility of capital, and it comes down to this very basic concept of, we're just talking about the plumbing between risk and capital and the speed at which it can move. And ILS capital is like reinsurance capital. It can move relatively quickly. It's not like equity capital, which and some of the debt capital, which is a bit stickier. And it's providing, I think, flexible mechanisms for that to move around. I mean, and this is one of the compelling advantages of traditional reinsurance. It provides a huge amount of capital relief in an incredibly efficient and straightforward way. And that is what ILS is sort of essentially has to compete against. I mean, the attraction of ILS is, of course, that you're accessing supposedly a different capital base. And if I look at some of the big issues that the insurance industry is facing, the current capital base is not sufficient to cope with it. But you can't just cede, really big tail end risks to ILS markets. That won't work. ILS investors need
Not in the long term.
No, they need a more balanced diet to make it work.
And send all the cyber to them.
Well, if we could work out how to model it and give a reason or persuade them it was modeled. So I think it will be a gradual evolution. But as I said, I think the key is I see this evolution more towards rated paper, even if it's only fronting, because it makes it so much easier for the original issuing company to manage one way or another. That's my current sort of estimate. And I just, we were on a call this morning looking at climate change and what that's doing to insurance companies and the holistic risk that now represents to them and their balance sheets and their entire operations. It throws up all sorts of very interesting issues that will need to be managed through some form of risk transfer. But they're going to be quite complicated and quite customized according to each company one by one. So I think it is that's probably my view. But I think any process that can be put in place to make it a bit easier and take out some of the lumps and bumps and clunkiness. I mean, don't forget, traditional reinsurance has been going for over 150 years. So, you look at a traditional reinsurance contract, there's a huge amount in there that's all taken for granted. And why? Well, because we've got a legal history going back over 100 years of what these particular words mean. And so it is very streamlined in that sense compared to ILS. So any process that makes ILS more streamlined will ultimately help, and it will help grow the market. There's no doubt about that.
Great, thank you, James. Frank or Tobias, I think you're about to talk.
Yeah, I was this morning in a conversation about toxic clauses, James, of COVID, just to mention one. And when I was listening to you and Benjamin, and because Benjamin fully agreed, it's a small market. Nevertheless, it reminded me very much when in Lloyd's, streamlining the process became a topic, which was completely manual, and we all have been there, I guess, and we all walked there with our paper under the arms, and we went from one to the other, and it was protected like the Holy Grail. And then shortly, or some will say suddenly, the process has been streamlined, and that was kind of the start when speedy decisions could be made. And maybe that's, I don't want to jump into a solution, John, but I just, it reminded me, the conversation reminded me very much about the Lloyd's conversation we had a couple of years back and still have.
Frank and Benjamin, we're closing in on our time. So Frank, you go. Anything to say?
I think there's still, besides all obstacles we have touched today, there's still a big need for kind of standardization, for kind of streamlining, as James and Tobias pointed out, of the process. And I think technology can be a very large benefit here, because it doesn't mean necessarily we have to standardize too much, Depending on how small the building blocks are, the tokens, which have been talked about earlier, if the tokens are small enough, if the building blocks are a very good fit to the needs of the sponsor, and the process is streamlined such that besides the issuing cost can be lowered, and also from the point of the investors, there's kind of more transparency or more efficiency in the market. This will be a large benefit to everyone around the table here, maybe, and particularly to the outside world that is interested in getting some investment opportunities which are not very correlated to traditional asset classes. So I think there's still a need of streamlining and standardization. I hope we can make some progress in here.
Thank you, Frank. Benjamin, I'll leave you with the last word before we just have a couple of extra things on the end. Just want to tag those in. So if you can hold on for a couple of minutes, it would be great. So Benjamin.
Absolutely. Yeah, thank you very much. I think something which is important to keep in mind when we talk about the potential improvements to the ILS market with respect to technology is that ILS is at the same time in the securities world and in the reinsurance world. And I think in the securities world, there are advancements or prototypes being conducted with respect to streamlining certain processes such as settlement, and the capital market may benefit from those improvements in the future. But where I see the biggest potential at the moment, especially from the perspective of investors like you mentioned, Frank, for whom it might be quite a complex market, quite a complex asset class, is the reinsurance side of things. And I think there are a lot that has been looked at, in particular by the B3I for reinsurance contracts, and that can definitely apply to to the capital market, because it's essentially the same type of contracts which are underlying such transactions.
Thank you, Benjamin. John, can I give you 30 seconds just to maybe round up your thoughts, and then I'll ask Luba to come in and just explain the last bit of the process and what we have lined up next.
So I mean, firstly, thank you, everyone. We really appreciate this. This is really useful for us. As I said, this is a topic that comes up frequently. We're having conversations with the Insurance Authority of Hong Kong, obviously the Greater Bay Initiative. They're trying to position themselves as an area, likewise the BMA as well. And we have one foot in technology, one foot in insurance. We're not experts in this space, but to be able to consult with you and kind of bring you our thoughts and coalesce this into something. As I said, we're not into solutioning now. It's amazing listening to this conversation and seeing how there are parallels with so many things that we're working on already. But we learn that through what you share with us. So the idea of standardization of data, sharing of information between transacting parties is, that's in our wheelhouse. So I do look forward to getting to that part on this journey with you.
Thanks, John. Luba, do you just want to turn your camera and microphone on? Luba's just going to give us a quick account of the innovation program as a whole and sort of what the next steps are. Luba.
Yes, we're over time, so I'll be very quick. So thank you very much for the interesting conversation. There were a lot of topics raised, operational ones and fundamental ones. And obviously, we cannot address all the problems raised. And the way we work in our innovation lab is in innovation cycles. So each innovation cycle is a focused 12 weeks cycle where we try to solve one particular problem area. So if you are to pick such a problem area, very focused within ILS, what would it be? The problem should be potentially solvable by tech and quite narrow, so we can address it. So if you can share your thoughts, that would be great.
Yeah, so I can start. And I think my answer will be quite obvious. It's been a recurring theme, and yeah, that's around basically the data that you have that you do not have on Bloomberg, which is not the very security related part of of an ILS, but it's more the reinsurance part of such a security, which you don't find in a standardized manner, and which requires processing by all the market participants. And I think the same way we can standardize reinsurance contracts data, you can standardize that part of the data, and that can help in the whole life cycle of a catastrophe bond, be it at issuance, but also upon all the resets that may occur during the life of the catastrophe bond.
Okay, thank you. So standardization of underlying of the security. Okay.
Exactly.
Thank you.
Yeah.
Sorry, James.
No, I was going to say, I think that's the most important one. As a secondary one is looking at the claims process, because that's another complicated area. But I mean, obviously having a standard contract in one place, observable by all, and hopefully a smart contract, that would be a big step forward.
Thank you. Anyone else?
Frank or Tobias, did you have any final thoughts?
No, I just agree to the two, because I guess that's the root cause.
Thank you, Tobias. Frank, anything from you?
I'll leave that to the practitioners, not the managers. From a management perspective, I'm flying too high.
Guys, thank you so much for staying a little bit over. Really appreciate the hour that we've had already. The recording will make that available to you as well, so you can just rewatch it. But again, thank you so much for joining us. We have more stages in this, as Luba mentioned, and we'd love to be able to reach out to you for your expertise in the future. So thank you very much.
Okay. Thank you very much.
Thank you.
Thank you,
everyone.
Bye-bye.
Bye.
Have a nice
Thank
day.
you. Bye-bye, and good luck for tonight.
Bye-bye.
Thank you for attending this session. If you're interested to start your journey with re-inlab, please register online at re-inlab.crowd.group or send us an email to the address on screen now.